Hey guys, Rafi here from the Endgame Investor, and today we're going to talk about the monetary dungeons.
The pit of despair. Don't even think.
What is going on in the sewers where all of the repo money is sloshing around, $2.2 trillion worth every single day and climbing? What the mainstream media won't tell you, and what most of the alternative financial media aren't even aware of, is that interest rates in the overnight range of the yield curve are out of whack, out of the Fed's target ranges, which now is between 1.5 and 1.75%. The secured overnight financing rate, which is the repo rate, which is the heaviest traded overnight rate in the world at about $1 trillion a day. It is out of range. It is too low. Why is that? Because there is too much money chasing too few treasuries. Fed cannot keep interest rates within its target ranges, it has lost control of the entire monetary system. And that control is slipping and slipping fast. And we're going to go into the numbers and what happens if they totally lose control. So let's get to it. Here we have the effective federal funds rate. This is probably the most famous of the overnight rates. It's what one bank charges another bank. But you see here that the daily volume of the effective federal funds rate is quite low. It's between 70 and 80 billion, sloshing around 70 to 90 billion. It's not that much money. You see here the range in the final column. The range is now 1.5 to 1.75. This is after the 75 basis point hike that was made on June 16th. Now, this rate, 1.58%, is the weighted average of the percentiles. That is within the range of 1.5 to 1.75. So on the surface, it looks like the Fed has control of the overnight interest rates. However, move over to the secured overnight financing rate. Now, keep in mind, this effective federal funds rate, one bank to another, borrowing cash overnight, $80 billion volume. Move over to the SOFR, and what do we have? We have $976 billion. Basically, nearly $1 trillion, sometimes over $1 trillion here on May 31st at the close of the month. Close to $1 trillion is traded every day in the SOFR. And the range is the same range, the same target range as the EFFR, the effective federal funds rate. It's not written here in a column because that's it's the EFFR table, but it's the same range, same target range. And we see what the rate is here. It is 1.45. Remember June 15th, before the 75 basis point hike, the range was 0.75 to 1%, and it was trading out range there as well, 0.7, whereas the lower bound was 0.75. Still, the lower bound was 0.75 here and here and here, and it's been trading out of range basically since June 8th. What is causing these overnight interest rates to trade below range, below the Fed's target? And the answer is there's just too much money that is leaking in from outside the system. And what is that money outside the system? Those are reverse repos. That's all the money that was printed to buy all the bonds given to the banks that they can no longer house because it's too much. So they shove it back to the Fed in return for treasuries, and they get interest on that, which is even more money that they earn that they have to stuff into the Fed. So it keeps growing and growing and growing. But that money will eventually leak into the economy, and I believe that is already happening, and that is why overnight interest rates are out of range, because there's too much money coming in from the reverse repos, flooding the short side of the yield curve. Let's look at it this way. Here I have the reverse repos. Reverse repos, again, when a bank has too much cash and they have to give it to the Fed in exchange for treasuries or other collateral, so they don't have the cash overnight and they save on penalties. And so these reverse repos are now at a record high, $2.229 trillion. But how do they correlate with the balance sheet? See here, this gentle rise is QE3 from 2013 to 2015. This is when it stopped. And as the balance sheet stopped expanding, you had these periodic spikes in the reverse repo rate. You see that blue line. And those spikes are at quarter ends and year ends. That's when reverse repos spike. And then as the balance sheet was being shrunk over here from about 2018 until 2019, this is the repocalypse, when overnight rates jumped up to 10% and they had to start expanding their balance sheet. This is before the COVID era. You see as the balance sheet in the red started to shrink, so the reverse repos fell close to zero. and that is when that extra money went into the banking system. And then around 2021, reverse repos started to go vertical from around 0 in February 2021 to now $2.229 trillion. Now, when the Fed stops expanding its balance sheet, these reverse repos are going to come out of the Fed and into the money supply, into the banking system, and is going to flood the banking system with cash. And as the banking system is flooded with this reverse repo cash, because now it has a place to go as interest rates are hiked, the Fed is going to lose control of the money supply. So as they raise rates, the money supply is going to increase, which is going to make price inflation even worse and weaken the dollar even further. If you have $2.2 trillion in reverse repos, you can't just erase that. It is now part of the financial system, and it will cause extreme stress if that is simply canceled out by a monetary drain. My thesis is this: in order to get their interest rates back within target range, the Fed is going to have to drain all or most of the reverse repo money, which is about $2.229 trillion. And in order to drain it, they've got to get that money into the banking system and out of the dungeons.
We are going to die!
And only then, with the money supply much higher than it is now, will short-term interest rates like the secured overnight financing rate, like the repo rate, go back in range. Until then, they should continue to trade below target range. The reverse repos tend to come out of reverse repos and go into the banking system when the Fed starts reducing its balance sheet, as happened the last time they started reducing their balance sheet. Now here's one more article, so we can pinpoint when exactly this reverse repo money is going to start leaking out of reverse repos, leaking out of the dungeons and into the economy. Here's CNBC. We are not members or subscribers, because why would I waste my time with CNBC? All we need is the headline and the date. Look at this. The Fed's balance sheet reduction officially starts Wednesday. Here's how it works. I don't care how it works. I just want to know when it's happening. It's starting Wednesday. And when was this article published? Published Tuesday, June 14th, 2022 at 12:03 p.m. EDT. Which means the Fed's balance sheet reduction program started on June 15th. It is now June 19th, and we have already kicked this off. So what we should see in the next few weeks to months is reverse repos starting to fall and gently fall down. I don't know how gentle you could be with $2.22 trillion.
Gently!
But as gentle as you can with that, that's how it'll fall. I don't believe that the overnight rates will trade in range until most of this money is drained. And so we have another ingredient in the soup of hyperinflation being added to the stew. And that is all of the reverse repo money is about to flood the banking system. It won't happen all at once. It will be a trickle, then it will be a deluge, and finally it will be an explosion in prices of everything, exacerbating the current shortages and increasing the money supply. It's all the check marks being checked. How much time we have, I don't know, but get ready, guys. It's going to get rough from here. This is Rafi of the Endgame Investor. If you like this sort of monetary analysis, then sign up for a 2-week free trial of the Endgame Investor and see how I cover this stuff and issue trade alerts concurrently. And you can also become my patron on Patreon, where you will get an extra weekly video of biblical commentary on monetary policy. Do you think the Bible has anything to say about monetary policy and liberty? It certainly does. Find out what at the link in the description below. And good luck to the Fed on controlling the money supply, because it's going to need it.